Right? So let me continue. Chapter 2, evaluating financial performance. So in chapter 1, we learned the basic financial statements which we rely on when we need to derive some accounting information. And in this chapter, chapter 2, we are going to learn the basic method to use those information. So we are going to learn about the ratio analysis. And there are a lot of financial ratios that people are using, but we are just going to focus or highlight the ROE as the center of other ratios. The ROE, the return on equity, will be our center to study different ratios. And I'm going to explain you later the reason. And then maybe at the end of today's lecture or in the next week, I will be able to let you know the limitations that ROE has, and the ways to curb these limitations. And we are going to apply it to a US company, Hasbro, which is a company selling toys and some things for the kids, such as Transformers and other robots. And then we will move on to the next chapter. Okay, and I'd like to emphasize that there is no official definition for each financial ratio we are going to learn. Financial ratios are used because they are practical, but not because they are written in the law, right? Or in the textbook. So other people can have other definitions for the financial ratios. For example, sometimes you call debt to assets as leverage, but sometimes other will call debt to equity as a leverage. So there can be miscommunication if you are not clarifying the definition. So you need to be very careful when you read some reports from analysts or the information written in the Yahoo Finance. Okay, and we are going to use those ratios, and this is called as ratio analysis. When we try to construct some ratio by dividing some number with other numbers written on the financial statements, and then we try to compare different ratios. And this is called a ratio analysis. And the reason that we are doing this ratio analysis is because we want to know the financial performance of a firm. And there are several aspects if you are going to talk about a financial performance. So basically, it is better if you earn more. So we are going to talk about the profitability, and at the same time, you need to be very effective in using your resources, and that will be called as efficiency. And sometimes you do not only rely on your own money as a shareholder, but sometimes you will borrow funds from others. This is called leverage. So we are going to talk about these three different dimensions of financial performance, and then we are going to conclude. First, we have profitability measures. So by profitability, what I mean is the degree to which a firm yields financial gain. So whether a firm has a positive net income or a negative income. And there are a lot of measures to show or summarize the profitabilities, but I'd like to emphasize profit margin among others. And another measure is gross margin, but I have a asterisk here. In this chapter, this kind of asterisk means that I'm not going to directly mention it in this lecture, but it is written on your textbook. So it is relatively not that important compared to the previous one. So I'm just going to skip it, because if we are going to talk about every ratios we have, then we need a tons of time. So what is a profit margin? A profit margin is calculated as net income divided by the sales. Very simple. And let's look at these two items. The net income as well as sales, they are written on the income statement. And more precisely, the sales is the top line of your income statement. So this is the first thing you will see from the income statement. And then you deduct some expenses as well as others, and then eventually you obtain the net income at the bottom of the income statement. So this is on the bottom line. So this is the final thing you will find from the income statement. So basically, this profit margin measure is summarizing income statement. And then what it is summarizing? It is summarizing these expenses. So you start from the sale, and then you remove expenses, and then eventually you get net income as the result. So it shows you whether or not you have a lot of cost or expenses or not. So it measures the fractions left over after deducting expenses, and it reflects a firm's ability to minimize the cost or to control operating cost. So, for example, if you have a lot of cost in your operation, then net income will be very, very small compared to the sale, so that you get a profit margin of a lower number. On the other hand, if you do not need to pay those things, so your costs are very small, and then net income will be enlarged so that your profit margin will be a higher number. So that's how it works. So it summarizes the income statements. So let me give you a simple example. According to the textbook, in 2016, Hasbro had sales of $5,020 million. So M stands for million. So I'm just going to skip it because every number has million here. So I'm just going to call it 5020. And net income of 551. And then very simply, profit margin is 551 divided by 5,020. So you get 0.11, which is often lower than 1 because net income will be smaller than the sales, right? Because you start from the sales and deduct every expenses, you get a smaller number as a net income. So generally, this profit margin is lower than 1. So you have you have some digits after the dot, and we often make it as a percentage by multiplying 100. So we will just call it 11%. Okay, and the next dimension I'd like to talk is the efficiency. So efficiency means the degree how you use your resources. So for example, a company, so if you think about the profitability, it is very simple. So you have to earn a lot if you are running a business successfully. And second thing that you have to be very careful if you are running a company is that you have to take care of your assets. So let's say that you are selling some toys in a small town, and then you have many inventories, but you actually forgot that you had those inventories and you bought another inventories again. So that's the waste of your resources. And we don't want to have that situation because we need to use each of our asset item valuably. So by efficiency, it means that you are taking care of your assets and there's no left over. And a simple measure is called asset turnover. And if you just focus on a specific item in the balance sheet, you can get some kind of turnover measures such as inventory turnovers. And also there are other ways to measure the efficiency. For example, you can calculate the collection period of days sales in cash. So basically these two, I'm not going to talk more, but this simply put, these are how much you need to wait until you start to create your product and then you receive your cash. So if it is short, it means that you are generating cash in a relatively short period of time, so you are very effective. On the other hand, if it takes longer, then you are not that efficient. So asset turnover. So let me explain in a short example by why this is called asset turnover. All right. So let's assume that I'm selling some toys in a small town. I'm running a shop, and I often buy the products, merchandise, which worth of $100. Okay. So in my shop, I usually put my products, which is worth of $100. So this is my shop, and then I have many products, which is priced as $100. So I pay $100 to my supplier, and then I get my inventories. And then at the end of this year, I found that I actually sold $1,000, so that my sales was $1,000 this year. So this means I had 10 times of buying this merchandising and selling those merchandise. So I bought the merchandise for the first time and I sold them all, and then I again go back to my supplier and then I bought another merchandise and I came to my office and then I sold it, and I repeated this thing 10 times. So this is how you create from $100 inventory to create $1,000 sales. So that's why we call it asset turnover. So by dividing sales with assets, you can simply calculate how many times you are able to remove your inventories and fill them again. Okay, and then for a larger company, asset turnover means whether you are very successful in generating the sales from the asset. So for example, here for my little shop, I have 1,000 over 100, which is 10 times. So if I have a higher ratio, it means that I am generating more sales with this limited space. But on the other hand, if I have a smaller number, for example 5, that means I'm not that good in generating sales from the limited assets. So higher number means higher efficiency. So if you have a higher asset turnover, it means that you are allocating your resources, which are called assets, very effectively, and then so you are running your business very well. Okay, and for Hasbro in 2016, total assets was 5,091, and sales was 5,020, and then the asset turnover will be calculated as sales divided by total assets, so you get 0.986. we do not multiply 100 and make it percentile because this is times. This is often referred as times. So we do not want to make it into percentage. And the third dimension I like to share is the leverage. If you go back to your science class in the middle school or the high school, you will learn that if you are using your spoons or other derivers, then you can open a beer can with very few power, right? This is called leverage. So you can use your tools to maximize your power even though you start with a very limited power. So in terms of finance, leverage means that you are using not only your own money, but you are borrowing some others' funds so that actually you can run more assets, so that you can have more assets, even though it would have not been possible without the borrowed fund. So why do we want to multiply assets? Why do we want to have more assets? This is because you can get a larger profit if you have a larger scale. So let's go back to my previous example. So I'm selling merchandise from this small shop, but let's compare this small shop to a, say, Walmart or E-Mart. Then the sales or the profitabilities are totally different between this small shop and the large mall because they have different size of assets. So when you have a larger asset, it is basically more easier to generate more income. So that's why we want to increase our leverage so that we can have more assets. But you know that whenever you make a choice, there is a consequence. So regarding leverage, the benefit you can have is that you can increase your asset size, but at the same time, you have a cost of bankruptcy. So if your business is very successful, then there's no problem at all because everybody will be happy. But on the other hand, if your business is not that successful, then eventually those who gave you the money will come and say, get my money back. So that's the problem. Yes?
If you're managing a company and that you want some investments, don't you have to calculate you have to calculate if it's going to be for the investors? No?
Yes, you need to be you need to make sure that your investment will be profitable. But if everyone succeeds, then there will be no reason to study it. So yeah, so basically, even though we try to do our best to have successful investments, but sometimes we fail, so that sometimes we are going to in a bankruptcy situation. So there are also a lot of measures calculating leverage, but I'd like to introduce two measures: debt to assets and equity multiplier. Okay, first, debt to asset is very simple. So this is debt divided by assets. So you have all total liabilities, and then you divide it with assets. And it shows, because these two items are from the balance sheet, it is summarizing your balance sheet. So basically, the assets are your resources to make money, and liabilities and equities are about where those money are from. So liabilities are from others, and shareholders' equities are your own money. So if you are calculating this debt to asset, it means how much you need to pay first before you get it. Before you need to pay to others because you borrowed money from others. So it measures the claim of the liability holders on your assets. And the next measure is equity multiplier. And this is calculated as the asset divided by equity. So in terms of the leverage, it is more intuitive. It means even though you start with small amount of money called equity, you were able to have a lot of assets by having leverage. So this is also calculated in terms of times. And these two measures have the same information. They rely on the balance sheet. So we need to, sometimes we need to convert something into the other, but you can, let me explain it. So it's not that difficult. So debt to asset is debt divided by asset. And if you, according to the fundamental accounting principle, that will be the same as asset minus equity, right? And you need to divide it with asset, as it is written here. And then it will be 1 minus equity over asset. So you have a common denominator. So you can get 1 because you have asset over asset and equity over asset. And equity multiplier, according to that definition, equity multiplier is asset over equity, which is the reversed version of this equity over asset. So therefore, you can say that this is 1 over equity multiplier, right? So you have debt to asset is 1 minus 1 over equity multiplier. And if you move this term to on the left side, and if you move this term on the right side, you get 1 over equity multiplier will be 1 minus debt to asset. And because this is a reversed number, equity multiplier will be 1 over 1 minus debt to asset, and that's we have in this lecture note. And the reverse is also possible, and you will be able to obtain this result if you try this. So debt to asset will be 1 minus 1 over equity multiplier. Yes?
For the debt to asset ratio, how high should it be for the company to be healthy?
Oh, yeah, that's a very good question. So sometimes people ask whether this ratio is adequate or not. And actually, there is no answer. So you can have a higher debt to asset, for example, even 0.9, which means you are the 90% of your money is from others. But at the same time, you can have only you can have zero debt to asset, actually, which means you are only using your own money. So it depends on your industry situation and also economic situations as well. So basically, what we often say is that you don't have an absolute number which is correct, but you can compare your number with others so that you can have some ideas about running your business. So, for example, if your industry competitors are having, say, debt to asset lower than 0.3, and you are the only one who is relying more on borrowed fund, say, with debt to assets of 0.9, then you are in some kind of trouble. Maybe something is wrong with your company because others are not doing this. So maybe there will be some reason why others are not doing this. Okay? Yes. Yeah. Can you write down your name after we finish our class, so that I can give you an extra credit? Yes. Thank you.
또 에퀴티를 자체분으로 보여줄 수 있어요.
아, 네, equity는 자기 자본입니다.
만약에 보통주로 보게 되면 보통주도 에퀴티로 실현을 많이 하던데 그거는 다르게 생각해야 돼요.
아, 네, 지금 제가 쓰고 있는 여기 equity라는 용어는 그냥 그 자기 자본 전체예요. So it could be misguiding if you interpret this equity as just common stock, right? So here the term equity means the total shareholders' equity, not only one item in the shareholders' equity. For example, there are common stock, preferred stocks, and capital input as well as retained earnings. So there are a lot of items. So I'm just using the equity as a total term. Okay. So before finishing today's lecture, I'd like to calculate the leverage for the hospital by using these two measures. Let's say hospital has assets of 5,091 and liabilities of 3,200, and then debt to asset will be very simply calculated as 3,000 divided by 5,000. So you get 63%. And then equity multiplier, in the calculation of the equity multiplier, you need to have another step, which is obtaining the value of equity from these two information. So you go back to the fundamental accounting principle, and you calculate the equity as the difference between assets and liabilities, and then you use it as a denominator, and then you get your equity multiplier as 2.73. So here these two have the same information, because debt to assets of 63% means you among 100% of your assets, 63% are coming from others, liability holders. So the remaining approximately 30% are coming from shareholders, right? And because 30% are composing 100%, you have 3 times equity multiplier. So they have the same information, but it is given in different forms.